Before we begin, a quick and important disclaimer. I am not a licensed financial advisor, and the information presented in this video is for educational and entertainment purposes only. This presentation is not, and should not be considered financial, legal, or investment advice. Investing in the stock market involves risk, including the potential loss of principal. Please consult with a qualified professional before making any financial decisions. Your financial situation is unique, and any action you take based on the information in this video is solely at your own risk. You work hard. You put in the hours, you pay your bills, you try to save what's left over. But every time you look at that savings account, it feels like you're just treading water. The interest rate is a joke, and you know deep down that the value of your hard-earned cash is slowly getting eaten away by inflation. It's a frustrating, sinking feeling. A feeling that you're on a financial treadmill, running faster and faster just to stay in the same place. What if I told you there's a system, a machine really, that has been the single greatest driver of wealth creation in modern history? A machine that, for over a century, has been available to the public, yet feels like it's guarded by a secret society of Wall Street wizards speaking a language you don't understand. Let me put it this way. Back in 2011, if you had taken the $600 you spent on the brand new iPhone 4S and instead bought $600 of Apple stock, you'd be looking at over $10,000 today. If you had done the same with Netflix stock, you'd be sitting on over $25,000. This isn't about getting lucky. It's not about gambling or timing some secret trade. It's about understanding how to participate in the growth of the most successful companies in the world. And here's the big lie you've been told. That this machine, the US stock market, is too complicated, too risky, or too exclusive for someone like you. You've been made to feel that you need a PhD in economics or a six-figure salary just to get a seat at the table. You see the flashing numbers on the news, you hear terms like bulls, bears, and quantitative easing, and your brain just shuts down. It's designed to feel intimidating. It's designed to keep you on the sidelines, leaving your money to stagnate in a savings account, while the real growth happens somewhere else. Well, today that ends. Over the next 10 parts of this guide, we are going to shatter that lie. My promise to you is simple. I will demystify the stock market. I will translate the jargon into plain English. I will give you a clear step-by-step roadmap that will take you from a complete beginner, someone who doesn't even know what a stock is, to a confident investor with a plan for your future. No fluff, no get-rich-quick nonsense, just the foundational knowledge you need to take control of your financial destiny. And we're specifically talking about 2026. Why? Because the world has changed. The economic landscape we're entering is unlike anything we've seen before. We're navigating the long-term effects of massive government spending, the rise of artificial intelligence as a dominant force in every industry, and a fundamental shift in how and where people work. These aren't just news headlines. They are massive currents that will create incredible opportunities for those who understand them, and significant risks for those who don't. Getting started now in this new era isn't just a good idea, it's essential. So let's start at the very beginning. The absolute ground floor. What even is a stock? Forget everything you think you know. I want you to picture your favorite local coffee shop, the one with the great espresso and the comfy chairs. Imagine the owner wants to expand. She wants to open a second location across town, buy a bigger, better roasting machine, and hire more staff. But all of that costs money. Money she doesn't have just sitting around. So she decides to divide the ownership of her entire coffee business into 1,000 tiny, equal pieces. Think of it like a giant pizza cut into 1,000 identical slices. Each one of these slices is a share of the company, a share of stock. Now, she can sell some of these slices to the public to raise the money she needs. Let's say you love her coffee, you believe in her business, and you want to be a part of its success. You decide to buy one of those slices, one share of stock. Congratulations! You are now a part owner of that coffee shop. You don't have to manage the employees or clean the espresso machine, but you own a tiny piece of the entire business. If the business does well, you do well. If that new location is a huge success and the company's profits double, the value of your slice of the pizza, your share, goes up. That's the core concept. A stock is simply ownership. When you buy a share of Apple, you are buying a tiny fraction of ownership in the company that makes iPhones. When you buy a share of Ford, you own a piece of the company that builds F-150s. You are not just buying a ticker symbol on a screen. You are buying a piece of a real, living, breathing business. Now, this leads to the most important question. How do you actually make money from this? There are two primary ways. The first way is the one most people think of. It's called capital appreciation. Let's go back to our coffee shop. You bought your share for $10. A year later, the owner has successfully opened that second location, profits are soaring, and everyone wants in on the action. Your slice of the business is now more valuable. People are willing to pay $20 for that same share you bought for $10. If you decide to sell it, you've made a $10 profit. Your initial capital of $10 has appreciated. This is what happens when you hear that a stock price has gone up. The underlying business became more valuable, and so did your piece of it. The second way you make money is through something called dividends. Imagine the coffee shop has an incredibly profitable year. After paying all the bills, buying new equipment, and setting aside money for future growth, there's still a big pile of cash left over. The owner decides to share some of those profits directly with her fellow owners, the shareholders. You, as the owner of one share, you might get a small cash payment, say 50 cents for every share you own. This payment is a dividend. It's your reward for being a part owner of a successful, profitable company. Some companies, especially large, stable ones, are famous for paying regular dividends to their shareholders, providing a steady stream of income. So, you can make money when the stock's price goes up, and you can also make money from the company sharing its profits with you along the way. Now, you can't just walk up to Apple's headquarters and ask to buy a share. There needs to be a central place where buyers and sellers of these shares can meet and make transactions easily. This place is the stock market. It's not a physical building anymore, not really. It's a massive global electronic network of exchanges. In the United States, the two big ones you'll always hear about are the New York Stock Exchange, or NYSE, and the NASDAQ. Think of them as giant, incredibly organized marketplaces. The NYSE is home to many of the older, more established industrial giants, while the NASDAQ is famous for its technology companies like Apple, Amazon, and Microsoft. These exchanges are where millions of shares of thousands of companies are bought and sold every single second of the trading day. They ensure the process is fair, transparent, and orderly. So, to recap what we've just covered, a stock is a small piece of ownership in a company. Companies sell these pieces to raise money to grow their business. As an owner, you make money in two ways: when the value of your piece goes up, which is capital appreciation, or when the company shares its profits with you, which are called dividends. And all of this buying and selling happens on a centralized marketplace known as a stock exchange. You now understand more than 90% of the population about what a stock actually is. You've built the foundation, but this is where the real questions begin. Okay, so I want to buy a piece of a company. How do I physically do that? Do I need a special account? And which company should I even be looking at? What's the difference between a solid company like Coca-Cola, a risky new tech startup, and this thing everyone keeps talking about called an ETF? How do you actually find and choose your first investment? That is the critical next step. And it's exactly what we are breaking down in part 2. Imagine you walk into the world's largest grocery store. The aisles stretch for miles. One aisle has thousands of different kinds of apples. The next, thousands of different oranges. Another has these weird exotic fruits you've never even heard of. You came here to buy fruit to be healthier, but the sheer number of choices is paralyzing. Do you bet everything on this one perfect-looking apple? Or do you buy a prepackaged fruit basket? This is exactly what it feels like to choose your first investment. You're standing in the middle of the stock market, surrounded by thousands of options. To cut through the noise, you need to understand that nearly all of your choices fall into 3 main categories. Think of them as the 3 fundamental flavors of investing: the single scoop, the sampler platter, and the curated box. Let's start with the single scoop. This is the one you hear about in movies. This is buying an individual stock. When you buy a stock, say 1 share of Apple, you are literally buying a tiny microscopic slice of the Apple company. You are now a part owner. If Apple does well, invents the next life-changing device, and its profits soar, the value of your tiny slice goes up. You win. But if their new product is a flop, or a competitor eats their lunch, the value of your slice can plummet. You lose. The appeal of the single scoop is obvious: control and explosive potential. You get to be the genius who picked the next Amazon in its garage phase. If you had invested $1,000 in Microsoft back in 1986, you'd be a multimillionaire today. That's the dream. But here's the brutal reality. For every Microsoft, there are thousands of companies that burned out, faded away, or went completely bankrupt, taking all their investors' money with them. Picking individual stocks isn't just gambling. It requires real work. It means reading financial reports, understanding the industry, analyzing the competition, and believing in the company's leadership. It's like being a detective and a fortune teller at the same time. For a beginner, it's like walking into that giant grocery store, closing your eyes, and trying to grab the one single apple that will win the blue ribbon at the state fair. You might get lucky, but the odds are stacked against you. So while it's the most talked about flavor, it's also the riskiest. Now let's talk about the second flavor, the one that has fundamentally changed investing for everyday people, the sampler platter. In the investing world, this is an ETF or an exchange-traded fund. Specifically, we're going to talk about its most popular form, the index fund. Forget trying to find the one perfect apple. What if you could buy a single basket that automatically contains a tiny piece of all the best apples, oranges, bananas, and more? That's an index fund. An index is just a list of companies. The most famous one in America is the S&P 500. It's a list of the 500 largest, most influential public companies in the United States. Think Apple, Microsoft, Amazon, Google, Johnson & Johnson, Visa. They're all in there. When you buy one share of an S&P 500 ETF, you are not betting on a single company. You are buying a tiny slice of all 500 of them all at once in one simple purchase. You're not trying to pick the winner. You are simply betting on the entire US economy to grow over time. If one company in the basket has a bad year, it's okay because it's balanced out by the other 499. This is the single most important concept for a new investor: diversification. It's the opposite of putting all your eggs in one basket. You're spreading your risk so widely that the failure of one, or even a dozen companies can't sink your ship. The beauty of this approach is its simplicity and its proven track record. You don't need to read financial reports. You don't need to guess which tech startup will be the next big thing. You are passively investing, harnessing the collective power and growth of the entire market. And because it's managed by a computer algorithm that just copies the list, the fees are incredibly low. For most people, most of the time, the sampler platter is the smartest, most reliable way to start building wealth. It's not as sexy as picking a single stock, but winning with money is rarely about being sexy. It's about being consistent. Finally, we have our third flavor, the curated box. This is the traditional mutual fund. Sounds a lot like an ETF. It's also a basket of investments, but there's one critical difference. Instead of passively tracking a list like the S&P 500, a mutual fund has a human, a highly paid fund manager, actively picking and choosing which stocks go into the basket. They are the professional chef, creating a special dish they believe will outperform everyone else. The idea is that you're paying for their expertise. This manager and their team of analysts spend all day researching companies, trying to find hidden gems and sell off losers before they fall. In theory, this sounds great. Why not hire a pro to do the hard work for you? The problem is, it rarely works out that way. Study after study has shown that the vast majority of these active fund managers fail to beat the simple, boring S&P 500 index fund over the long term. And for the privilege of trying, they charge you much higher fees. These fees, often seeming small at just 1 or 2%, act like a constant leak in your financial bucket, draining away tens or even hundreds of thousands of dollars from your returns over a lifetime. 20 years ago, the curated box was one of the only options for everyday investors. But today, with the rise of low-cost ETFs, it's like paying a celebrity chef to make you a fruit salad when you can get a better, cheaper, and more reliable one right off the shelf. So let's bring it all together. The single scoop, individual stocks, offers high risk and high reward, best for those who want to do the homework. The curated box, mutual funds, offers active management but comes with high fees and a history of underperformance. And then there's the sampler platter, the low-cost index fund ETF. It's diversified, it's simple, it's proven. For 95% of beginners starting their journey in 2026, this isn't just the best choice. It's the revolutionary tool that has leveled the playing field, allowing anyone to build long-term wealth by simply and steadily betting on the market as a whole. Okay, you've made your choice. You've decided against trying to find that one magic apple. You're going with the big, diversified basket of America's 500 best companies. You know what you want to buy. But now comes the next, equally confusing question. Where do you actually go to buy it? You can't just walk into a bank and say, "One S&P 500, please." You need to open a special kind of account at a special kind of company. This company is your gateway to the entire world of investing. It's called a brokerage. But which one do you choose? The old-school giant like Vanguard? The modern, app-based one like Robinhood? What's the difference and which one is right for you? Choosing your brokerage is the critical next piece of the puzzle. and making the right choice now can save you a fortune in fees and headaches down the road. Think of your brokerage account as your mission control. It's the cockpit from which you'll navigate the entire universe of the stock market. Some cockpits are incredibly complex, covered in dials and switches, designed for seasoned astronauts who need every possible piece of data at their fingertips. Others are sleek, minimalist, with a single touchscreen that does almost everything for you, designed for the everyday space tourist. Neither is inherently better, but choosing the wrong one for your mission can lead to confusion, frustration, or even disaster. Let's start with the titans, the old guard of the investing world. I'm talking about companies like Charles Schwab, Fidelity, and Vanguard. These are the Boeings and Lockheeds of the financial industry. They've been around for decades, they manage trillions of dollars, and they have a reputation built on stability and trust. For a long time, these were the only option, and they often came with a hefty price tag. You'd pay a commission, a fee, every single time you bought or sold a stock. Want to buy one share of Apple? That'll be $7.95, please. But then the game changed. The rise of the internet and a new wave of competitors forced these giants to adapt or die. And adapt they did. Today, most of these legacy brokerages offer zero commission trading on US stocks and ETFs. They essentially had to match the new guys on price. So what's their selling point now in 2026? It's their sheer firepower. When you open an account with a Schwab or a Fidelity, you're not just getting a button to buy stocks. You're getting access to a fortress of financial resources. We're talking about world-class research reports from dozens of sources, sophisticated charting tools that let you analyze a stock's every move, and educational resources that could fill a university library. If you want to dive deep, to become a true student of the market, these platforms give you the tools to do it. Furthermore, they offer a vast universe of investment products. Beyond just stocks, you can easily invest in mutual funds, bonds, CDs, and international markets. It's a one-stop shop for your entire financial life. And perhaps most importantly, when you have a problem, a trade that won't go through, a question about your tax forms, you can usually pick up the phone and talk to a real live human being. In a moment of financial panic, that single feature can be priceless. But there's a flip side. For a beginner, logging into one of these platforms can feel like stepping into the cockpit of a 747 without a pilot's license. The sheer number of options can be overwhelming, a classic case of analysis paralysis. The user interfaces, while powerful, can sometimes feel a bit dated or clunky, designed more for function than for elegant simplicity. This is where the disruptors saw their opening. Enter the new wave. Robinhood, Webull, M1 Finance. These are the SpaceX and Blue Origins of the brokerage world. They didn't just build a better version of the old thing. They reimagined the entire experience from the ground up, for a mobile-first generation. Their philosophy was simple. Investing should be for everyone, not just the wealthy, and it should be as easy as ordering a pizza. Their interfaces are clean, intuitive, and frankly beautiful. They stripped away the complexity and focused on the core actions. Search for a stock, see its price, and tap a button to buy it. They pioneered zero commission trading, making it the industry standard. But their most revolutionary feature was arguably the widespread adoption of fractional shares. Before, if you wanted to own a piece of a company like Amazon, whose stock might trade for thousands of dollars per share, you had to save up a huge chunk of cash. Fractional shares changed everything. Now, you can invest with whatever you have. $5? You can buy $5 worth of Amazon. $1? You can own a tiny sliver of Tesla. This single innovation blew the doors of the stock market wide open for millions of people who felt priced out. The downside? This sleek simplicity comes with trade-offs. The research tools on these apps are often basic compared to the legacy brokers. You'll get a simple chart and maybe a few news headlines, but not the deep dive analysis. Customer service can be notoriously difficult to reach, often relying on email or chatbots instead of a phone call. And there's the controversial side, gamification. The confetti that rains down after a trade, the constant notifications, the slick design. Critics argue it can encourage impulsive, casino-like behavior rather than thoughtful, long-term investing. There's also the business model of payment for order flow, where they route your trades to high-frequency trading firms in exchange for a fee. While they argue it helps them offer commission-free trading, it has raised questions about whether you're always getting the absolute best price on your trades. So, we have two distinct philosophies. The Titans offering power, comprehensive tools, and a sense of institutional security, at the cost of potential complexity. And the disruptors offering simplicity, accessibility, and a beautiful user experience, at the cost of fewer features and a different set of risks. How in the world do you choose? You don't choose the best one. You choose the right one for you. This decision comes down to your personality and your goals. Let's break it down. Are you the passive investor? Your goal is to build long-term wealth with minimal effort. You plan to buy a few broad market index funds or ETFs, contribute money regularly, and not look at it for 20 years. For you, a titan like Vanguard or Fidelity is likely a perfect fit. Vanguard, in particular, is structured to benefit its fund investors, and their entire philosophy is built around low-cost, long-term passive investing. The slightly more complex interface doesn't matter to you because you'll barely be using it. Or are you the active learner? You're fascinated by business, you want to pick individual companies, analyze charts, and really get your hands dirty. You want to learn as you go. Here you have a choice. You could go with a disruptor like Webull, which offers more advanced charting tools than Robinhood and is geared towards more active traders. Or you could start with a titan like Charles Schwab, knowing that their powerful desktop platform Thinkorswim is something you can grow into as your skills develop. Finally, are you the curious beginner? The whole thing feels a little intimidating. You just want to dip your toe in the water with a small amount of money, say 50 or 100 bucks, to see how it all works. For you, the simplicity and fractional shares offered by an app like Robinhood are almost impossible to beat. It removes the barriers to entry and makes that very first investment feel easy and accessible. The key is to recognize that as your needs grow, you might eventually graduate to a more robust platform. So before you open any account, ask yourself these 3 critical questions. 1. How do I want to invest? Am I a passive set-it-and-forget-it type or an active hands-on learner? 2. How important is customer service to me? Do I need the security of knowing I can call a human, or am I comfortable with a digital-only experience? 3. What do I need beyond just buying stocks? Will I eventually want access to retirement accounts like a Roth IRA, mutual funds, or bonds all in one place? Your answers will point you to the right mission control for your journey. Don't just pick the one your friend uses. Spend an hour, look at their websites, maybe even download a couple of the apps to see how they feel. This is a foundational decision. Making the right choice now sets the stage for everything that follows. Once you've chosen your brokerage, you'll link your bank account, and for the first time you'll see your own money sitting there, ready to be deployed into the market. It's a thrilling moment, but it's immediately followed by the biggest question of all. You have your cockpit, you're cleared for launch. But where are you going to fly? What do you actually buy? Do you buy a piece of a single company like Apple, a stock? Or do you buy a basket of hundreds of companies all at once, an ETF? What about a mutual fund? What's the difference, and which one is the secret to building real long-term wealth? That is the most important decision you'll make as a new investor, and it's exactly what we're breaking down next. Imagine you walk into the world's largest grocery store. This is the stock market. You've got thousands of aisles, millions of products, and your goal is to assemble the perfect cart of groceries that will feed you for the rest of your life. You could go aisle by aisle, picking each individual item yourself. One apple from Apple Incorporated, a carton of milk from a dairy company, a box of computer chips from NVIDIA. This is stock picking. It's time-consuming, requires expert knowledge, and if you pick a few bad apples, your entire meal could be ruined. Most people don't have time for that. So you have 2 other options. Option 1. You hire a world-famous, expensive personal chef. This is a mutual fund. You tell the chef, "My goal is to have the most nutritious, best-tasting meals." The chef says, "No problem. I'm an expert. I'll go shopping for you. I'll use my secret techniques and connections to find the best ingredients, better than anyone else can. Just give me your money, and at the end of every day, I'll present you with a cart of groceries I've selected." Sounds amazing, but there's a catch. The chef is expensive. He takes a significant percentage of your grocery budget for himself every single year, whether his meals are good or bad. And you can only get your groceries from him at one specific time, 4 p.m. when the market closes. Option 2. You see a beautifully packaged, pre-assembled meal kit. This is an exchange-traded fund or ETF. This kit was designed by a team of top nutritionists to give you a perfectly balanced, diversified meal. It has a clear label on the front listing every single ingredient inside and the exact percentage of each. You can see the price tag, and that price is updated live every second. You can grab this box off the shelf and buy it at 9:37 a.m., sell it at 2:15 p.m., whatever you want. And the best part? It's incredibly cheap, because you're not paying for one celebrity chef's ego and intuition. You're paying for a proven, transparent recipe. The personal chef is a mutual fund. The meal kit is an ETF. And understanding the profound difference between these two is the single most important financial decision you will likely ever make. Let's talk about that personal chef, the actively managed mutual fund. For decades, this was the default option for investors. A brilliant fund manager, a modern-day stock market wizard, and their team of analysts work around the clock buying and selling stocks, trying to outsmart everyone else. Their goal, their entire sales pitch, is to beat the market. They promise to get you returns that are better than the average. To deliver this supposed magic, they charge you a fee, called an expense ratio. It's expressed as a percentage, and it sounds deceptively small. Maybe 1%. You think, 1%? That's nothing. If they're making me an extra 5%, I'm happy to give them 1. This is the lie that has cost American investors trillions of dollars. Let's do some quick, brutal math. You invest $100,000. A 1% expense ratio costs you $1,000 in your first year. But it gets so much worse. That $1,000 isn't just gone. You also lose all the future growth that $1,000 would have generated. Over 30 years with average market returns, that tiny 1% fee doesn't just cost you $30,000. It can vaporize over $250,000 from your final retirement nest egg. It's a $250,000 leak in your financial boat, all going straight into the pockets of the fund company. But surely it's worth it if they beat the market, right? Well, here's the devastating secret of Wall Street. They don't. Year after year, study after study proves the same shocking fact. The vast majority of these highly paid, active fund managers fail to beat their benchmark index over any meaningful period. The S&P Dow Jones Indices releases a report called the SPIVA Scorecard. It's the industry's official report card. The latest data is almost comical. Over the last 15 years, more than 92% of large-cap active funds in the US failed to beat the S&P 500. Let that sink in. You have a 9 out of 10 chance of paying someone a massive fee to underperform a simple, boring, cheap alternative. You hired the world's most expensive chef, and for 15 years straight, his meals have been worse than the simple recipe you could have gotten from a kit for a fraction of the price. On top of that, the structure of mutual funds can be a tax nightmare. When the fund manager sells a winning stock inside the fund, that creates a capital gain, and that tax liability is passed on to you, the investor, even if you never sold a single share of the fund yourself. You can literally get a tax bill for profits you never personally touched. It's inefficient, it's expensive, and the performance just isn't there. Now let's look at the meal kit, the ETF. Specifically, the most popular kind, the passive index fund ETF. This is the game changer. An index ETF doesn't have a celebrity chef. It has a computer and a simple set of rules. For an S&P 500 ETF, the rule is, own the 500 largest companies in the US, weighted by their size. If a company drops out of the top 500, sell it. If a new one enters, buy it. That's it. There are no gut feelings. No brilliant predictions. No expensive teams of analysts. It's an automated, rules-based system designed to do one thing: match the performance of the market, not beat it. And because it's so simple and automated, it is dirt cheap. Remember that 1% expense ratio on the mutual fund? The expense ratio for some of the biggest S&P 500 ETFs today is around 0.03%. That's not 1%. It's not even 1/10 of 1%. It is 33 times cheaper. Let's run our math again. You invest that same $100,000. The 0.03% fee costs you $30 a year. Over 30 years, the total cost of those fees might rob you of around $7,000 or $8,000 from your final portfolio. Now, that's still money, but compare it to the $250,000 the mutual fund took. The ETF lets you keep hundreds of thousands of dollars more of your own money. The ETF is the single greatest wealth-building invention for the average person in the last 50 years, precisely because it cuts out the expensive middleman. Plus, they're more flexible and transparent. You can buy and sell them all day long, just like a stock. The price is clear. And they are structured to be far more tax efficient, generally preventing those phantom capital gains distributions that plague mutual fund investors. So let's put it side by side. On one hand, you have an actively managed mutual fund, a promise to beat the market that very rarely comes true, burdened by high fees that decimate your returns, tax inefficiency, and rigid end-of-day trading. On the other hand, you have a passively managed index ETF, a strategy designed to match the market, with incredibly low fees that let you keep your money, greater tax efficiency, and the flexibility to trade whenever you want. The choice is not just clear, it's overwhelming. For the vast majority of beginner investors, the path to building long-term wealth is not through finding the next genius stock picker. It's through systematically and consistently buying low-cost, broadly diversified index ETFs. But don't just take my word for it. Let's ask the single greatest investor of all time, Warren Buffett. For decades, people have asked him what the average person should do with their money. His answer has never wavered. In his 2013 letter to Berkshire Hathaway shareholders, he laid out the instructions for the trustee of his own wife's inheritance. He wrote, "My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund." He didn't say, "Find the smartest mutual fund manager." He didn't say, "Pick the next hot tech stock." He, a man whose entire life has been about picking stocks, said that for almost everyone, the best path is to simply own a piece of everything, as cheaply as possible. In 2026, the best tool to follow that billion-dollar advice is the index ETF. It is the democratization of investing. It gives you, the beginner, the same powerful wealth-building engine that financial advisors and even Warren Buffett recommend, for a fraction of the old-school cost. You've made the decision. No expensive, underperforming personal chefs. You're going with the simple, powerful, and affordable meal kit. You're going to buy an S&P 500 ETF. So you log into your new brokerage account, you go to the search bar, and you type S&P 500 ETF. And suddenly a list pops up. Voh, please buy. They all say they track the S&P 500. Their performance charts look identical. Their fees are all razor thin. So, which one do you actually buy? Is there a secret handshake? A hidden difference that could cost you thousands? And once you choose, what buttons do you actually click to make it yours? How do you go from knowing what to buy to actually owning it? That's the final barrier between you and becoming an investor. And it's the exact process we're walking through click by click next. So you've done the research. You've picked your brokerage. You've funded your account. You're staring at the screen, and you feel this mix of excitement and pure, undiluted terror. It's like being handed the keys to an airplane. You know it's powerful, you know it can take you places, but right now it's just a dizzying wall of buttons, numbers, and blinking lights. Your mission is simple: buy one share of one company. But where do you even start? Let's demystify this entire screen right now. The single most important tool on this page is the simplest one: the search bar. Just like Google, this is your gateway. Every publicly traded company has a unique code, a shorthand name called a ticker symbol. Apple is Apple. Amazon is Amazon. Ford is just F. Think of it as the company's unique address on the giant map of the stock market. You type that ticker into the search bar, hit enter, and you're taken to that company's specific command center. Now your screen is filled with new numbers. Don't panic. You only need to understand a few of them to make an intelligent decision. The most obvious one is the price, displayed in big, bold numbers. Let's say it's $150. But here's the first secret the pros know. There isn't just one price. Look closer. You'll see two prices: a bid price and an ask price. The bid is the highest price a buyer, somewhere out in the world, is currently willing to pay for the stock. The ask is the lowest price a seller is willing to accept. The price you see in big bold letters is usually just the last price a trade happened at. The tiny difference between the bid and the ask is called the spread. Think of it like a negotiation at a flea market, happening millions of times a second. The buyer wants to pay a little less, the seller wants to get a little more. And the trade happens when they meet in the middle. For big, popular stocks, this spread is usually just a penny. It's not something to worry about, but understanding it means you're already ahead of 90% of beginners. Okay, what else matters on this page? You'll see a 52-week range. This is simply the highest and lowest price the stock has hit in the last year. It's a quick glance tool that gives you context. Is the stock currently trading near its yearly high, its yearly low, or somewhere in the middle? It tells you a small piece of the stock's recent story. Next, look for volume. This is a huge one. Volume is just the number of shares that have been traded today. Is the volume in the thousands or in the millions? High volume means it's a busy, popular stock with lots of buyers and sellers. It's like a bustling city marketplace. Low volume means it's a quiet side street. As a beginner, you generally want to stick to stocks with higher volume, because it means you can easily buy or sell without any issues. Finally, the most important number on this page besides the price is the market cap, which stands for market capitalization. This is the total value of the entire company. It's calculated by taking the share price and multiplying it by the total number of shares that exist. Why is this so critical? Because it stops you from making a classic rookie mistake. Thinking a stock with a low price is cheap, and a stock with a high price is expensive. A $10 stock isn't necessarily cheaper than a $500 stock. The $10 stock could be for a tiny company with a market cap of $50 million. The $500 stock could be for a global behemoth like Google, with a market cap of over $1 trillion. The share price is just the price of a single slice of pizza. The market cap tells you the value of the entire pizza parlor. Always look at the market cap to understand the true size and scale of the business you're buying into. Alright, you've looked at the numbers. You're comfortable. You're ready. You see it. The big, beautiful, terrifying green button that says buy. You take a deep breath, you click it, and a new window pops up. This is the final step. This is where you give your instructions, and you have a few choices to make. This is where most people get confused, but we're going to make it incredibly simple. The first choice is your order type. You will almost always see two main options: market order and limit order. A market order is the simplest. It's you telling your broker, I want to buy this stock right now, at whatever the best available price is. You're prioritizing speed over a specific price. You click buy, and within a second you'll own the shares at, or very near, the current asking price. For a big, high-volume stock like Apple or Microsoft, a market order is perfectly fine. The price isn't going to swing wildly in the half-second it takes to place your order. The downside: in a very fast-moving, volatile stock, the price you actually pay might be a little different from the price you saw when you clicked the button. This is called slippage. Your other option is a limit order. This puts you in total control. A limit order is you telling your broker, I want to buy this stock, but I am not willing to pay more than a specific price. You set your price, your limit. Let's say a stock is trading at $50.25. You can place a limit order to buy at $50. If the price drops to $50 or lower, your order will automatically execute. If it stays above $50, your order just sits there waiting and does nothing. The upside is obvious. You guarantee you'll never pay more than you want to. The downside: your order might never get filled. If you're too greedy and set your price too low, the stock might just run up without you, leaving you on the sidelines. So which one should you use? Here's a simple rule for 2026. If you're buying a large, stable ETF or a blue-chip stock for the long term, and you're not trying to time the market to the exact penny, a market order is fast, easy, and effective. If you're buying a more volatile stock, or if you have a very specific price in mind that you believe is a good value, use a limit order. It gives you precision and protects you from sudden price spikes. The next box you'll need to fill is the quantity. And here is another game-changing feature of modern brokerages. You can usually choose to buy in terms of shares or in terms of dollars. Buying by shares is straightforward. I want to buy 10 shares of this company. The broker calculates the total cost and you confirm. But what if one share of Amazon costs a couple $100 and you only have $50 to invest? This is where buying in dollars comes in. You can simply say, I want to buy $50 worth of Amazon. And thanks to something called fractional shares, your broker will buy you a small slice of a single share. This is one of the single greatest innovations for new investors. It means you are no longer priced out of owning the best companies in the world. You can own a piece of any company, no matter the share price, with as little as $1. So you've selected your order type. Let's say market order. You've selected your quantity. Let's say $100 worth. You see the summary screen. It shows you what you're buying, how much you're buying, and the estimated cost. Everything looks good. You click the final button. Submit order. Confirm trade. Whatever the final wording is. For a split second, nothing happens. Then the screen refreshes. And there it is. A confirmation. Your order to buy 0.67 shares of XYZ has been filled. It's done. The money is out of your cash balance and it's been converted into a tiny piece of ownership in a real, living, breathing business. You're not just a consumer of their products anymore. You're an owner. You are officially an investor. Take a moment to let that sink in. You've broken through the technical barrier. You've navigated the cockpit, translated the jargon, and successfully taken flight. But as you look at your new position sitting there in your portfolio, a whole new set of questions emerge. The real journey, the emotional roller coaster of watching your money work, has just begun. What do you do now? What happens on day 2? And more importantly, what do you do if you wake up tomorrow and your very first investment is immediately down 5%. How you handle that moment will define your success as an investor more than anything else we've discussed. And it's exactly what we're breaking down next. So that screen flashes red. That number that was a positive green yesterday is now a negative red. Your stomach drops. Your first thought isn't logical. It isn't analytical. It's pure gut-level fear. I made a mistake. I'm losing money. I need to get out. This is the first great filter of investing. It's the moment that separates the people who will build wealth from those who will churn their accounts to zero, paying fees and locking in losses along the way. In this moment, you stand at a crossroads with two very distinct paths in front of you. Path 1 is the path of panic. The investor on this path sees that -5% and their heart starts racing. They immediately open their news app. The headlines are screaming. Market tumbles on inflation fears. Recession looms, experts warn. Every article confirms their worst fears. The fear turns into a certainty. It's going to go lower. I need to sell now to prevent a 5% loss from becoming a 20% loss. So they hit the sell button. A small wave of relief washes over them. They did it. They stopped the bleeding. But what happens next? The market might dip another 2%. See, they think, I'm a genius. I got out just in time. But then a day later it bounces back 4%. The next day it's up another 3%. Suddenly they're not just back to where they started, they're behind. Now a new fear kicks in, FOMO, the fear of missing out. They feel they need to get back in before it runs away without them. So they buy back in, but at a higher price than they sold for. They now own fewer shares for the same amount of money. A week later, the market dips again. The cycle repeats. This investor is perpetually buying high and selling low. The exact opposite of the goal. All driven by the emotional roller coaster of the daily news cycle. Path 2 is the path of perspective. The investor on this path wakes up, sees the -5%, and feels that same initial knot in their stomach. They're human after all. But they don't open the news app. They don't immediately reach for the sell button. Instead, they take a breath and ask themselves two simple questions. First, has anything fundamentally changed about the great American companies I invested in since yesterday? Did Apple stop selling iPhones? Did Amazon shut down its warehouses? Did the entire S&P 500 suddenly become worthless overnight? The answer is almost certainly no. The second question is, did my reason for investing change? Am I still saving for a house in 10 years? For retirement in 30? Is my time horizon still long-term? The answer is yes. So, with those two questions answered, they close the app. They might go for a walk. They might focus on their work. They accept that volatility is the price of admission for the long-term returns the stock market provides. They understand that what the market does today, this week, or even this year, is mostly just noise in the context of a multi-decade journey. The reason that first path is so tempting, so common, is because of a powerful quirk in our brain's wiring called loss aversion. Psychologists Daniel Kahneman and Amos Tversky proved that the pain of losing $100 is roughly twice as powerful as the pleasure of gaining $100. Your brain is literally hardwired to feel losses more acutely than gains. This was a fantastic survival mechanism when our ancestors were trying not to get eaten on the savannah. Avoiding a loss like a predator was far more important than finding a gain like a berry bush. But in the modern world of investing, this instinct is a catastrophic bug in our software. It makes us want to sell at the first sign of trouble, turning a temporary on-paper dip into a permanent real-world loss of capital. So how do you overwrite that faulty programming? How do you force yourself onto the path of perspective? You do it by building a strong investing mindset before the storm hits. First, you learn to zoom out. When you see your portfolio is down for the day, I want you to mentally picture the chart of the S&P 500 not for the last 24 hours, but for the last 50 years. It's a jagged line full of terrifying drops and euphoric climbs. You'll see the dot-com bust, the 2008 financial crisis, the 2020 pandemic crash. They look like horrifying cliffs when you're living through them. But when you zoom out, you see they are just small dips on a powerful, undeniable, upward-sloping mountain of growth. Every single major crash in U.S. market history has eventually been followed by a new all-time high. Internalizing this visual is your first line of defense. Your 5% drop is just one tiny, insignificant downward tick on that massive mountain. Second, you reframe the narrative. You have to stop thinking of a market downturn as a disaster and start thinking of it as a sale. Imagine your favorite store is having a 20% off everything sale. Do you run out of the store screaming, vowing never to shop there again? Of course not. You get excited. You see it as an opportunity to buy the things you already wanted at a better price. The stock market is the only store in the world where, when things go on sale, people run out the door. If you believe that an S&P 500 index fund was a good investment last week at its all-time high, it is, by definition, an even better investment this week when it's 5% cheaper. This mindset shift from, "I'm losing money," to "everything is on sale," is the single biggest psychological leap you can make as an investor. Third, understand that it's not a real loss until you sell. When your portfolio shows a negative number, what you're seeing is an unrealized loss. You still own the exact same number of shares of the exact same companies. If you own 10 shares of a company, you own 10 shares whether the price is $100 or $90. The only thing that has changed is the market's current mood about what those shares are worth. By selling, you are voluntarily choosing to make that temporary mood a permanent reality for your finances. By holding on, you give the company and the market time to recover and continue its long-term growth. Let's make this real. Imagine you were a brand new investor in January of 2020. You put your first $10,000 into an S&P 500 index fund. You felt great. Then late February and March happened. The world shut down. The market didn't just drop 5%. It plummeted over 30% in a matter of weeks. The fastest, most terrifying crash in history. Every headline was apocalyptic. The investor on the path of panic saw their $10,000 become $7,000 and sold, locking in a $3,000 loss, thinking they were saving the rest. The investor on the path of perspective felt that same terror, but they held on. They zoomed out. They remembered their why. What happened? By August of that same year, the market had recovered completely and hit new all-time highs. The investor who held on was back to $10,000 and then some. The investor who sold was still sitting on the sidelines in cash, watching in disbelief, now facing the impossible decision of when to get back in. By the end of 2021, that initial $10,000 would have been worth over $14,000. One person lost $3,000. The other made $4,000. The only difference was their reaction in a moment of pure panic. Your first loss is a test. It's the market asking you, are you really in this for the long haul? Or were you just here for the easy gains? Passing this test doesn't require complex financial models or an MBA. It requires a pre-planned strategy. And for a beginner, the absolute best strategy for handling a market drop is this: do nothing. Seriously, the plan is to have no plan. Don't sell. Don't buy more just because it's cheap, not yet. Just let it be. Don't check your portfolio every hour. In fact, if the market is down significantly, delete the app from your phone for a week. The less you look, the less your faulty brain wiring can trick you into making a terrible decision. You've now survived your first test. You've learned to control the one thing that will derail more investors than anything else: your own emotions. You've built the mental fortitude to stay the course. But simply holding on to a single investment through a downturn is only half the battle. What if there was a way to construct your portfolio from the very beginning to be more resilient? A way to smooth out those terrifying drops and make the entire journey less stressful? There is. It's the closest thing to a free lunch in all of finance, and it's arguably the most important strategic concept you will ever learn. It's called diversification, and it's how we turn a portfolio of risk into a fortress of wealth. So how do we build this fortress? Imagine your life savings are a medieval kingdom. If you put all your gold in a single giant tower in the center of your castle, what happens when a dragon attacks that one tower? It's over. The whole kingdom's treasury is gone. But what if you distributed that gold among dozens of smaller, reinforced towers all along the castle walls? The dragon might take out one, maybe even two, but the rest of your treasure is safe. Your kingdom survives. That, in its simplest form, is diversification. It's the art and science of not putting all your eggs in one basket. But it's so much more profound than that. The magic isn't just about spreading your money around. It's about spreading it around things that don't all move in the same direction at the same time. Think about it. Owning stock in both Ford and General Motors is a start, but they're both American car companies. If a massive steel shortage hits or new regulations make cars more expensive to produce, both stocks are likely to suffer. You've spread your money, but your towers are all built on the same shaky ground. True diversification is about finding assets that have a low, or even negative correlation with each other. Correlation is just a fancy word for how two things move together. A perfect positive correlation means when one goes up, the other goes up by the exact same amount. Think of two hot dog stands right next to each other on a sunny day. Sales for both will probably go up. A perfect negative correlation is the opposite. When one zigs, the other zags. Imagine that hot dog stand and an umbrella vendor next to it. On a sunny day, the hot dog stand thrives while the umbrella vendor waits. On a rainy day, the umbrella vendor makes a killing while the hot dog stand is empty. If you owned both businesses, you'd have a much more stable, predictable income stream. You'd be making money whether it was sunny or raining. In the stock market, finding perfect negative correlations is incredibly rare. But we don't need perfect. We just need things that are imperfectly correlated. We need assets that dance to the beat of a slightly different drum. This is where we zoom out from just looking at individual companies and start looking at the entire economic landscape. The first layer of diversification is across different companies within the same sector. So instead of just owning Netflix, you might also own Disney and Warner Bros. Discovery. This protects you if Netflix makes a huge strategic blunder, but it won't protect you if the entire streaming industry faces a new disruptive technology. So, we go to the next layer, diversifying across different sectors and industries. This is critical. You own some technology stocks like Apple or Microsoft, but you also own healthcare stocks like Johnson & Johnson. You own consumer staples, the companies that sell things people buy no matter what, like toothpaste and toilet paper, think Procter & Gamble. You own some financial stocks like JP Morgan Chase. You own some industrial stocks like Caterpillar. Now, your portfolio looks less like a single car company and more like the entire American economy in miniature. When interest rates rise, your bank stocks might do well, even if your tech stocks take a temporary hit. When there's a boom in construction, your industrial stocks might soar, even if the healthcare sector is quiet. Each sector is a different player on your team. You don't build a championship football team with 11-star quarterbacks. You need linemen, receivers, a running back, and a rock-solid defense. Each has a different job, and they don't all have a great game on the same day. But together, they win championships. Your portfolio is your team. But wait, there's an even higher level. The ultimate diversification is across different asset classes. This is where you move beyond just owning stocks. Stocks or equities are one asset class. They represent ownership in a company. Another major asset class is bonds, also known as fixed income. When you buy a bond, you're not buying ownership. You're essentially lending money to a company or a government in exchange for regular interest payments and the promise that they'll pay you back. Historically, stocks and bonds have often had a low or even negative correlation. In times of economic fear and uncertainty, investors often flee from the perceived risk of stocks and pile into the perceived safety of government bonds. This pushes bond prices up just as stock prices are falling. They act like a seesaw. Having both in your portfolio is like having both the hot dog stand and the umbrella stand. Smooths out the ride. It's the shock absorber for your financial vehicle. This is why for decades the classic beginner portfolio was the 60-40. 60% stocks for growth, 40% bonds for stability. While the exact numbers are always debated, the principle remains unshakable. Owning different types of assets dramatically reduces your portfolio's volatility. So the big question is, how much is enough? Do you need to own 5 stocks? 20? 500? The research is fascinating. The biggest risk-reducing benefit of diversification comes from going from one stock to about 20 or 30 stocks in different sectors. After that, the added benefit of each new stock gets smaller and smaller. But why? Why can't you just own 5,000 stocks and eliminate all risk entirely? This brings us to the single most important academic idea in modern finance. And it's the secret behind the free lunch. There are 2 types of risk in the market. The first is called unsystematic risk. This is the risk specific to one company or one industry. It's the risk that a brilliant CEO retires, a new drug fails its clinical trials, a factory burns down, or a company gets hit with a massive lawsuit. This risk is random, unpredictable, and completely avoidable. This is the risk you eliminate through diversification. By owning 30 or more different companies, the random disaster that might strike any single one of them becomes just a tiny, insignificant blip in your overall portfolio. One of your castle towers might crumble, but the other 29 are standing strong. Diversification effectively vaccinates your portfolio against single company stupidity or bad luck. But there's a second type of risk. It's called systematic risk or market risk. This is the risk that the entire economy falters. A global recession, a major war, a pandemic, a financial crisis. This is the risk that makes the entire stock market tide go out, lowering all the boats at once. You cannot, I repeat, you cannot diversify away systematic risk simply by adding more stocks to your portfolio. If you own 500 US stocks, and the entire US economy enters a recession, all 500 are likely going to go down. This risk is unavoidable. And here is the beautiful multi-trillion-dollar insight. The market does not reward you for taking on unsystematic risk. Why would it? You can get rid of it for free just by diversifying. It would be like a casino paying you a bonus for betting your entire life savings on a single spin of the roulette wheel instead of making smaller, smarter bets. It makes no sense. The market only rewards you for taking on the one risk you can't avoid: systematic market risk. The potential for higher returns in the stock market is your compensation for bravely weathering the storms that affect everyone. So, the free lunch of diversification is this: you get to eliminate a whole category of risk, the dumb, uncompensated, company-specific risk, asterisk without asterisk sacrificing your expected return. You are shedding unnecessary risk for free. You are left with only the pure, market-level risk that historically has rewarded investors with growth over the long term. You're stripping your engine of all the useless, heavy parts that just slow you down, leaving only the powerful components that drive you forward. This all sounds amazing, right? Build a fortress, own a piece of every industry, balance it with other assets like bonds, and get a free lunch by eliminating a whole class of risk. But then reality hits. You're a beginner. You might only have a few hundred or a few $1,000s to start. How on earth are you supposed to buy shares in 30, let alone 500 different companies? The trading fees alone would eat you alive. And buying a single share of some companies can cost hundreds or even thousands of dollars. It seems like this perfect, diversified strategy is only available to the ultra-wealthy. For decades that was true. But not anymore. What if I told you there was a way to own a piece of every major company in America, from Apple to Walmart, with a single click for just a few dollars? What if you could instantly build that diversified fortress we've been talking about, more perfectly constructed than even a billionaire could have managed just 50 years ago? This invention has been called the single greatest financial innovation for the average person, and it's the key that unlocks everything we've just discussed. It's how you, as a beginner in 2026, can start investing like a world-class professional from day one. So what is this revolutionary invention? It's called the index fund. And its story, the story that completely changed investing for people like you and me, begins with a man who was fired from his job. His name was John C. Bogle. In the 1970s, Bogle was a rising star at a major investment firm, but a risky merger he championed went south, and he was unceremoniously shown the door. But Bogle had a radical, almost heretical idea. For decades, Wall Street had been built on a single premise: that highly paid, brilliant fund managers could use their expertise to pick winning stocks and beat the market. Investors paid them hefty fees for this supposed genius. But Bogle looked at the data, and the data told a different story. He saw that year after year, the vast majority of these genius fund managers failed to beat the market average. After you subtracted their high fees, their performance was even worse. They were charging a fortune for a product that didn't even work most of the time. It was like paying a Michelin star chef to make you a peanut butter sandwich. Bogle's idea was simple, yet it threatened the entire Wall Street establishment. He asked, what if, instead of trying to beat the market, we just bought the market? All of it. What if we stopped looking for the single needle in the haystack and just bought the entire haystack? In 1976, he launched the first index investment trust, now known as the Vanguard 500 Index Fund. It was designed to do one thing: mimic the performance of the S&P 500. It didn't have a star manager making brilliant bets. It didn't have a team of analysts searching for hidden gems. It just bought the 500 largest companies in the US and held them. Wall Street mocked him. They called his idea Bogle's folly. They nicknamed it un-American, because it was an admission that you couldn't beat the average. But Bogle understood a fundamental truth that they missed. By simply matching the market and, crucially, by charging incredibly low fees, his investors would, over time, outperform the majority of the high-fee funds that were trying so hard to be clever. He was right. And that one simple idea has created more wealth for more ordinary people than perhaps any other in financial history. So how does it actually work? Imagine the entire US stock market is one giant pizza. The biggest, most successful companies, the Apples, the Microsofts, the Amazons, are the biggest slices. The thousands of smaller companies are the smaller slices. For decades, the game was to try and pick which single slice of pizza was going to be the tastiest next year. It's a game of speculation, research, and a whole lot of luck. You might pick a great one, or you might pick one that gives you food poisoning. That's the risk of stock picking. An index fund changes the game entirely. An index fund says, I'm not going to try and guess. I'm just going to buy the whole pizza. When you invest in an S&P 500 index fund, you are buying a tiny fractional share of all 500 of the largest companies in America, all in one transaction. You instantly own a piece of the entire top tier of the US economy. This is the magic of diversification, but on steroids. Remember how we talked about not putting all your eggs in one basket? An index fund gives you 500 baskets automatically. If one company, one slice of that pizza, has a terrible year and goes bankrupt, what happens to your investment? Almost nothing. It's a tiny crumb of your overall portfolio. Its failure is cushioned by the success of the other 499 companies. You are no longer exposed to the catastrophic risk of a single company failing. You are simply betting on the long-term growth and innovation of the American economy as a whole. And historically, that has been the safest, most profitable bet in the world. The second superpower of the index fund is its cost. Because there's no genius manager to pay, no massive research team, and very little buying and selling, the cost of running an index fund is incredibly low. These costs are expressed as something called an expense ratio. An actively managed fund might charge you 1% or even 2% of your money every single year for their services. An index fund might charge you 0.04%. That sounds like a tiny difference, right? 1% versus 0.04%. But over your investing lifetime, that difference is an earthquake. Let's say you invest $10,000 and it grows at 8% per year for 30 years. With a 1% fee, you'd end up with about $76,000. With a rock-bottom 0.04% fee, you'd end up with over $100,000. That's a $24,000 difference. More than double your initial investment. That went straight into your pocket instead of Wall Street's. Vogel's folly wasn't a folly at all. It was a revolution for the small investor. Now, in 2026, this idea has evolved. You'll hear the term ETF more often than index fund. ETF stands for Exchange Traded Fund. For our purposes as beginners, you can think of an ETF as the modern, more flexible version of an index fund. They both achieve the same goal. They hold a basket of stocks to track an index, like the S&P 500. The main difference is in how they are bought and sold. Traditional index mutual funds are priced once a day, after the market closes. An ETF, however, trades on the stock exchange just like a regular stock. Its price fluctuates all day long. This makes ETFs a bit more flexible and, in some cases, slightly more tax efficient. For most beginners starting today, investing in low-cost, broad-market ETFs is the simplest, most effective path forward. And you're not just limited to the S&P 500. There are index funds and ETFs for everything. Want to own not just the 500 biggest companies, but the entire US stock market, including thousands of mid-size and small companies? There's a total stock market index fund for that. Want to invest in the biggest international companies from Europe and Asia? There's a total international index fund. Want to own the 100 biggest tech companies on the NASDAQ? There's an ETF that tracks that too. You can build a globally diversified, incredibly sophisticated portfolio with just 2 or 3 of these simple low-cost funds. This strategy completely rewires your relationship with investing. It shifts you from a speculator to an owner. You no longer have to worry about what some CEO said on a conference call, or whether a company's next earnings report will be good or bad. You don't need to check your stocks every day. Your success is no longer tied to the fate of 1 or 2 companies, but to the broad march of global capitalism. It allows you to tune out the noise, automate your investments, and focus on what truly matters. Your time in the market, not timing the market. But don't just take my word for it. Listen to Warren Buffett, the man known as the Oracle of Omaha, arguably the greatest stock picker who ever lived. He built a fortune of over $100 billion by carefully analyzing and selecting individual businesses. So what does he advise the average person to do? What does he advise his own family to do with their inheritance after he's gone? In his 2013 letter to shareholders, he laid out the instructions for the trustee of his wife's inheritance. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. He went on to say, "I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers." Think about that for a second. The greatest stock picker of all time, a man who built a legendary career proving it's possible to beat the market, explicitly tells the vast majority of people, including his own family, asterisk not asterisk to try. He tells them to buy the haystack, because he knows that for most people, trying to find the needle is a loser's game. Not because they aren't smart, but because the system of fees and emotions is rigged against them. You now understand the single most powerful tool available to a new investor. You know what you should be looking to buy. The question that's probably burning in your mind right now is, how? Where do you actually go to buy these index funds and ETFs? What's the first practical step you need to take to turn this knowledge into action? That requires opening a special kind of account, and choosing the right one is one of the most important decisions you'll make. It's the gateway between your bank account and your future wealth. So what is this gateway? It's called a brokerage account. And choosing where to open one, and more importantly what type of account to open, is like choosing the foundation for a skyscraper. Get it right and you can build to incredible heights. Get it wrong and the entire structure could be compromised. Think of it like this: there are two parallel universes for your money. In the first universe, every time your investments make a profit, the government shows up, hand outstretched, ready to take a piece. Every dividend you receive, every stock you sell for a gain, a portion of it goes to taxes. This is the world of the standard, taxable brokerage account. But in the second universe, things are different. It's a special zone, created by the government itself, with incredible tax advantages designed to encourage you to invest for your future. In this universe, your money can grow and compound for decades, completely sheltered from the drag of annual taxes. This is the world of retirement accounts. For a beginner, understanding the difference between these two universes isn't just important. It's the secret key to unlocking exponentially more wealth over your lifetime. Let's start in that second, more powerful universe. The most common accounts here are the IRA and the 401k. Let's break them down. First, the IRA, which stands for Individual Retirement Arrangement. Think of this as your own personal private retirement vault. You open it, you control it. There are two main flavors: the Roth IRA and the traditional IRA. This is one of the most important financial decisions you'll ever make. Let's talk about the Roth IRA. The Roth is the rock star of retirement accounts, especially for people just starting out. The deal is simple. You contribute money that you've already paid taxes on. So, if you earn $100 and pay $20 in taxes, you can invest the remaining $80. That might sound like a disadvantage at first, but here's the magic. Once that money is in the Roth IRA, it grows completely 100% tax-free. Forever. And when you retire and start taking money out, every single penny, your original contributions and all the massive growth over the decades, is yours to keep tax-free. Let me paint a picture for you. Imagine two friends, Sarah and Mike, both 25 years old. They both invest $5,000 into the exact same S&P 500 index fund. Sarah puts hers in a Roth IRA. Mike puts his in a standard taxable brokerage account. For 30 years, they don't touch it. Their investment grows at an average of 10% per year. After 30 years, their $5,000 has blossomed into over $87,000. Now retirement day comes. Sarah, with her Roth IRA, clicks withdraw, and the entire $87,000 lands in her bank account. No taxes, no fuss. It's all hers. Mike, on the other hand, clicks withdraw. But because his money was in a taxable account, he now owes capital gains tax on his $82,000 of profit. Depending on his income, that could be a tax bill of over $12,000, instantly vaporizing a huge chunk of his nest egg. Sarah is on a beach in Hawaii. Mike is writing a 5-figure check to the IRS. Same investment, same time frame, wildly different outcomes. That is the power of the Roth IRA. Now there are rules. The government limits how much you can contribute each year. And if you earn above a certain income level, you can't contribute at all. But for the vast majority of beginners, the Roth IRA is the single most powerful wealth-building tool you have. So what about its sibling, the traditional IRA? It's basically the Roth's mirror image. With a traditional IRA, you contribute money before you pay taxes on it. This is called a tax-deductible contribution. So, if you earn $60,000 in a year and you put $6,000 into a traditional IRA, the government only taxes you as if you earned $54,000. This lowers your tax bill today, which is a nice, immediate benefit. Your money then grows tax-deferred, meaning you don't pay taxes on it year after year. The catch? When you retire and start withdrawing that money, every dollar you take out is treated as regular income and taxed at whatever your tax rate is at that time. So the choice is simple. With a Roth, you pay taxes now and never again. With a traditional, you get a tax break now but pay taxes later. The strategic question is, do you think your tax rate will be higher now while you're working or later when you're in retirement? Most young people assume they'll be earning more and be in a higher tax bracket in the future, which makes paying taxes now with a Roth IRA the smarter move. Next up in the tax-advantaged universe is the 401k. This isn't an account you open on your own. It's a retirement plan offered by your employer. And if your employer offers one, it comes with a legitimate superpower: the employer match. This is, without a doubt, the closest thing to free money you will ever see in your life. Here's how it works. Your company might say, for every dollar you contribute to your 401k, up to 5% of your salary, we will contribute $1 too. If you make $60,000 a year, that means if you contribute $3,000, your company will just hand you another $3,000 and put it directly into your account. That is an immediate guaranteed 100% return on your investment. You will not find that anywhere else on planet Earth. Failing to get your full employer match is like taking $3,000 in cash, walking over to a paper shredder, and turning it into confetti. It is the absolute #1 financial priority for anyone with a 401k. Like IRAs for 401k. Also come in Roth and traditional versions, giving you the same choice of paying taxes now or later. They also have much higher contribution limits than IRAs, allowing you to invest significantly more each year. So that's the tax-advantaged universe. It's designed for one primary goal: long-term retirement savings. But what if you want to invest for something else? A down payment on a house in 5 years? Starting a business? That's where we go back to that first universe, the world of the standard taxable brokerage account. This account is all about flexibility. There are no contribution limits. You can put in as much money as you want whenever you want. There are no restrictions on when you can take your money out. If you invest today and need the cash next week, you can sell and withdraw it. This freedom is its greatest strength. But its weakness, as we saw with Mike, is taxes. Any dividends you receive are typically taxed each year. And when you sell an investment for a profit, you pay capital gains tax. The government splits this into two types. If you hold an investment for less than a year, it's a short-term capital gain, and it's taxed at your ordinary income tax rate, which can be quite high. But if you hold it for more than a year, it becomes a long-term capital gain, which is taxed at a much more favorable, lower rate. This is the government's way of encouraging long-term investing over short-term speculation. So, how do you put all this together? What's the battle plan for a beginner in 2026? It's actually a simple step-by-step priority list. Step 1. If you have a 401k with an employer match, contribute just enough to get the full match. Do not pass go. Do not invest anywhere else until you have captured every last cent of that free money. Step 2. After you've secured your match, shift your focus and open a Roth IRA. Contribute the absolute maximum you're allowed to for the year. The power of decades of tax-free growth is a gift you give your future self. Step 3. If you've maxed out your Roth IRA and still have money you want to invest for retirement, go back to your 401k and contribute more, up to its much higher annual limit. Step 4. And only after you have done all of that, captured the match, maxed the IRA, and are putting more into the 401k, should you then consider opening and funding a standard taxable brokerage account for your other shorter-term financial goals. This 4-step waterfall strategy ensures you are taking maximum advantage of the tax-sheltered accounts first, before moving into the taxable world. It's a blueprint used by millions of savvy investors to build their wealth in the most efficient way possible. Okay, we've covered the why, the what, and the how. You understand the power of compounding, the assets you can buy, and now the exact type of account you need to open. You are standing at the very edge of the diving board. The water is clear. You have the knowledge and the strategy. There's just one final piece of the puzzle. You know you need a brokerage account, but where do you get one? Who do you trust with your financial future? The internet is flooded with options: Fidelity, Vanguard, Charles Schwab, and a dozen slick new apps, all promising to be the best. They all look the same, but they're not. Some have hidden fees that can eat away at your returns, while others have tools that can give you a critical edge. Choosing the right platform, the right brokerage firm, is the final step before you can finally place your first trade. And that choice can make a huge difference in your journey. So let's break down what separates the good from the great, and the great from the ones that are just not right for you. Think of brokerages in 3 main categories, each with its own philosophy. First, you have the titans, the legacy giants. Companies like Fidelity, Charles Schwab, and Vanguard. These are the all-in-one financial supermarkets. They've been around for decades, they manage trillions of dollars, and their platforms are built on a foundation of trust and reliability. For a beginner focused on long-term, set-it-and-forget-it investing, especially for retirement, these are often the gold standard. They offer every type of account you can imagine, From a standard brokerage account to your Roth IRA, your 401k rollover, even accounts for your kids. Their research tools are typically top-notch, offering deep analysis and expert reports that can help you make informed decisions. And maybe most importantly, when you have a problem, you can usually get a human being on the phone. The trade-off? Their mobile apps might feel a bit less sleek, a little more corporate, and more complex than some of the newer players. They are built for wealth management, not just for trading. Then you have the second category, the modern fintech disruptors. This is your Robinhood, your Webull, your M1 Finance. These platforms were born on the smartphone. Their main selling point is an incredibly intuitive, often beautiful, user interface. They made investing accessible and, frankly, less intimidating for a whole new generation. They pioneered features like commission-free trading and fractional shares, which are now industry standard. Fractional shares are a game-changer for beginners. It means you don't need $4,000 to buy one share of a mega-cap tech stock. You can buy $10 worth or even $1 worth. This allows you to build a diversified portfolio, even with a small amount of starting capital. The potential downside to these platforms can be the flip side of their strength. Some critics argue they can gamify investing, using slick animations and a constant stream of notifications that might encourage frequent, emotional trading rather than a patient, long-term strategy. Their customer support might be more email or chat-based, and their research tools, while improving, are often less comprehensive than the legacy giants. The third category is more specialized, for active traders and professionals, with names like Interactive Brokers. They offer lightning-fast execution and access to global markets, but their platforms can be incredibly complex and overwhelming for a newcomer. For our purposes, as a beginner starting in 2026, you can safely put these on the back burner. Your focus should be on the first two categories. So how do you choose? It's not about which one is best, but which one is best for you. Create a checklist. First, fees. Yes, most trades are commission-free, but that's not the whole story. Look for hidden costs. Are there fees for inactivity? For transferring your account out? For paper statements? These small things can add up. Second, account types. Does the broker offer the accounts you need for your future? A Roth IRA is one of the most powerful wealth-building tools available. If a broker doesn't offer one, that's a major red flag for a long-term investor. Third, fractional shares. For a beginner in 2026, I consider this non-negotiable. It is the single best feature for building a diversified portfolio on a budget. Make sure your chosen broker offers it for a wide range of stocks and ETFs. Fourth, user experience. This is subjective. Some people love a data-rich, complex interface. Others need something clean and simple. Most brokers let you try a demo or at least see screenshots of their platform. Does it make sense to you? A confusing platform can lead to expensive mistakes. And finally, customer support. You might not think you need it until you desperately do. Read reviews. See what people say about getting help when something goes wrong. A 24/7 phone line might be worth more to you than a slick-looking app. Once you've made your choice, you'll go through the process of opening and funding your account. It's mostly online, similar to opening a bank account. You'll need your social security number and some personal information for identity verification. You'll link your bank account and transfer your starting capital, whether that's $50 or $5,000. And then you arrive at the moment, the culmination of all this research. It's time to place your first trade. You've picked your first investment. Let's say it's that S&P 500 index fund ETF we talked about. You type in its ticker symbol, and you're faced with a choice: market order or limit order. This is a crucial distinction. A market order says, buy me this stock right now at the best available price. It's the fastest and simplest way to buy, and it guarantees your order will be executed. For a large stable ETF, the price won't change much second to second, so a market order is generally fine. A limit order, on the other hand, gives you more control. It says, buy me this stock, but only if the price is at or below this specific amount I'm setting. For example, if a stock is trading at $100.50, you could set a limit order at $100. If the price dips to $100, your order executes. If it never drops that low, your order doesn't get filled. For beginners, a limit order protects you from sudden price spikes and ensures you don't pay more than you're comfortable with. When in doubt, the control of a limit order is often a safer bet. You type in the number of shares, or the dollar amount for a fractional share. You select your order type. You take a deep breath, and you click buy. And that's it. a confirmation screen pops up. You are now officially an owner. A part owner of hundreds of the biggest, most innovative companies in the United States. It might feel anticlimactic. There are no fireworks, no bells ringing. But what you've just done is profound. You have planted a seed. You've taken a concrete step toward building a different financial future. This single act, this first purchase, is the most important one. Not because of the money you'll make from it, but because it breaks the inertia. It demystifies the process and turns you from a spectator into a participant in the economy. But this is not the end of the story. It is the end of the beginning. Your journey from this point forward is defined not by frantic activity, but by consistency and patience. The goal now is to automate, to set up recurring deposits into your brokerage account and regular investments into your chosen funds. Every week, every 2 weeks, every month. This is dollar cost averaging in action. You're building your wealth brick by brick, regardless of whether the market is having a good day or a bad one. There will be times, I guarantee it, when you'll be tempted to abandon the plan. The market will crash. Pundits on TV will scream that the sky is falling. Your portfolio will be drenched in red. It will feel like you're losing. This is the great test of an investor. It's in these moments of fear that fortunes are truly made or lost. Not by timing the bottom, but by simply having the discipline to stick to your plan. To keep investing your regular amount, buying more shares at a discount. Remember the history we discussed. Every single market crash in U.S. history has been followed by an eventual recovery and new all-time highs. The people who lose are the ones who panic and sell at the bottom. The people who win are the ones who see the long-term picture and stay the course. Investing isn't about being a genius. It's not about finding the next 10-bagger stock before anyone else. For most of us, it's about temperament. It's about playing a game you can't lose if you just refuse to quit. It's about understanding that you're not buying ticker symbols on a screen. You're buying a stake in human ingenuity, progress, and the relentless drive of the global economy. Over the course of this series, we've journeyed from the fundamental question of why you should invest, to the mindset required, to the very assets you can buy. We've untangled the alphabet soup of stocks, bonds, and ETFs. We've laid out a simple, powerful strategy built for the long run. And now you've seen the final step. Choosing your tools and placing that first trade. The path is clear. The knowledge is yours. The only thing separating you from the future you want is action. The famous saying goes, the best time to plant a tree was 20 years ago. The second best time is now. The decisions you make today, the habits you start to build this week, will compound in ways you can barely imagine. Your future self, the 1, 10, 20, 30 years from now, is depending on you. They're hoping you have the courage to start, to be disciplined, to be patient. Don't let them down. Start today.